Financial engineering in simple terms. Financial engineering is a field that uses a lot of math and statistics to create, study, and handle financial products and strategies. Think of it like applying math to the world of finance to figure out the best ways to invest, price products, and manage risks. Three important areas of math that are used in financial engineering are calculus, probability theory, and stochastic processes. These are the tools that help experts build models and techniques for making sense of complex financial systems. Using calculus in financial engineering. Calculus is all about studying how things change over time, and in finance, it helps us understand how the value of investments or financial variables change. Two key ideas in calculus that are used in finance are differentiation and optimization. Differentiation is used to measure how fast things change. For example, when valuing options, financial products that give the right to buy or sell an asset at a set price, experts use differentiation to see how sensitive the option's price is to things like the asset's price and its volatility, how much its price fluctuates. Optimization is another important concept, where calculus is used to find the best solution, like the best mix of investments that balances the potential for high returns with low risks. Integration and accumulation. Integration helps us add up values over time, like figuring out how much future cash flows are worth today, called the present value. For instance, when valuing bonds, a type of investment where you loan money in exchange for future payments, integration helps calculate how much all those future payments are worth when adjusted for interest. Using probability theory in financial engineering. Probability theory is all about dealing with uncertainty and risk, which is a huge part of finance. It helps us understand the likelihood of different outcomes and their potential impacts. Important ideas in probability theory include probability distributions. These describe how likely different outcomes are. In finance, common distributions include the normal distribution, which helps model things like asset returns and volatility, and the log normal distribution, often used to model stock prices. Statistical inference. This is about making conclusions based on data. For example, by analyzing past market data, financial engineers can use statistical techniques to test if a particular investment strategy is likely to succeed. Expected value and variance. The expected value is like the average or most likely outcome, while the variance measures how much the outcomes can differ from the average. These are used to assess both the risk and potential return of an investment. Using stochastic processes in financial engineering. Stochastic processes are used to model systems that change over time in unpredictable ways, like financial markets. Some key stochastic processes in financial engineering are 1. Brownian motion. This is a model that describes random movements, like the ups and downs in asset prices. It's used in the Black-Scholes model, a famous method for pricing options. 2. Geometric Brownian motion, GBM. This is an extension of Brownian motion, specifically used to model stock prices. It takes into account both the random movements and a general trend, like the average growth of a stock. 3. Jump diffusion models. These models add the idea of sudden big changes, called jumps, to the basic models of asset price movement. They are used to capture events like market crashes or big news announcements that cause stock prices to jump or fall rapidly. 4. Stochastic differential equations, SDEs. These are mathematical equations used to describe how financial variables change over time when there's uncertainty. They combine both predictable trends and random factors. Introduction to financial markets and instruments. Overview of various financial instruments used in financial engineering. Financial markets are critical in financial engineering, providing platforms and tools for raising, distributing, and managing capital. Various financial instruments are used, each having specific characteristics and purposes. Financial engineers need to understand these instruments as they serve as the building blocks for developing new products and strategies. Here's a breakdown of some common financial instruments. Equities, stocks. Equities give ownership in a company, entitling shareholders to profits, often in the form of dividends. Stocks are a fundamental part of financial markets, and their pricing is a key area in financial engineering. Stock prices depend on multiple factors such as the company's performance, broader market trends, and economic conditions. Financial engineers use mathematical models to forecast stock prices, taking into account elements like earnings, interest rates, and market volatility. Bonds. Bonds are debt securities issued by corporations or governments, allowing them to borrow money from investors in exchange for interest payments. Bond characteristics include face value, coupon rate, and maturity date. Financial engineers analyze bond prices and risks using models that consider factors like interest rate changes. Techniques such as duration and convexity help assess how bond prices react to fluctuating interest rates, aiding in risk management. Derivatives. Derivatives derive their value from other assets, such as stocks, bonds, or commodities. They are often used for hedging risk or speculating on price movements. Key derivatives include options. Options allow investors to buy or sell an asset at a specific price within a set time frame. They are frequently used for hedging and speculation, with models like Black-Scholes aiding in pricing them. Futures. These contracts mandate the buying or selling of an asset at a future date for a pre-agreed price. They are primarily used for hedging against price volatility in assets like commodities or currencies. Swaps. Swaps are contracts where two parties exchange cash flows. Common swaps include interest rate swaps, where one party pays a fixed rate and the other a floating rate, and currency swaps, where cash flows in different currencies are exchanged. Structured products. These are investments that bundle traditional securities with derivatives to achieve certain goals, often used by institutional investors. Examples include collateralized debt obligations, CDOs. These pool together different debt instruments, such as mortgages or bonds, and divide them into tranches with varying risk levels. Investors choose tranches based on their risk appetite. Mortgage-backed securities, MBS. Backed by pools of mortgages, these securities offer investors regular payments from mortgage loans. MBS help manage mortgage risks and provide liquidity to the housing market. Commodities. Commodities are basic goods, such as oil, gold, or agricultural products that can be traded. Financial engineers use futures and options in commodity markets to hedge against price risks or speculate on price changes. Commodity prices are influenced by supply and demand, geopolitical events, and the overall economy. Foreign exchange, Forex. Forex markets involve currency trading with instruments such as spot contracts, forward contracts, and currency options. The Forex market is the largest financial market globally, operating 24 hours a day. Financial engineers use models to analyze currency movements and employ Forex instruments for hedging currency risk or speculating on exchange rate fluctuations. The role of quantitative analysis in financial engineering. Quantitative analysis is vital in financial engineering, revolutionizing the way financial markets are analyzed and manipulated. By using mathematical models and statistical methods, financial engineers create new products, optimize investment strategies, and manage risks with precision. Modeling and pricing. Financial instruments. One major use of quantitative analysis is in modeling and pricing financial instruments. Traditional methods of asset valuation have been greatly enhanced by quantitative techniques, providing more accurate and complex pricing. Option pricing models. The Black-Scholes model, introduced in the 1970s, was groundbreaking in pricing options. It uses stochastic calculus to determine the price of European options. More recent models like the binomial and Monte Carlo simulations allow for further refinement and flexibility in pricing various types of options. Fixed income securities. Quantitative models also play a key role in pricing fixed income securities like bonds. The Heath-Jarrow-Morton framework and the Cox-Ingersoll-Ross model are examples of models that analyze how interest rates change over time, providing insights into bond valuation and associated risks. Risk management and optimization. Quantitative analysis is crucial for risk management and optimization, offering tools to assess, manage, and reduce financial risks effectively. Value at risk, VAR. VAR quantifies the potential loss in a portfolio's value over a specific time frame at a given confidence level. Using historical data, Monte Carlo simulations, and parametric methods, VAR helps measure exposure to risk, enabling firms to set risk limits and determine necessary capital reserves. Portfolio optimization. The modern portfolio theory, MPT, and its extensions, like the Black-Litterman model, use quantitative techniques to optimize the balance between risk and return. By analyzing historical data, these models calculate expected returns and the covariance between assets to construct portfolios that minimize risk while maximizing returns.